Okay, let's continue with leasing. In the first session, we have seen discount rate being same as cost of debt. Now, predominantly the problem will revolve around discount rate being different from cost of debt. When they are different, obviously you'll have to do a detailed computation to get to the answer. Let's move to question 4. Question 4. XYZ Limited requires an equipment costing 10 lakhs. The same will be utilized over a period of 5 years. It has two financing options in this regard. Arrangement of a loan of 10 lakhs at an interest rate of 13% per annum. Loan being repayable in 3 equal year-end installments. Equipment will be sold at end of third year for 1 lakh. Leasing the equipment for a period of 3 years at a yearly rental of 5,50,000 payable at the year end. Rate of depreciation is 40%. Income tax rate is 35%, paid 1 year in arrears. Discount rate is 12%. Advise which of the financing option should XYZ Limited exercise and why. Go through the question. Okay, see, the asset is for 10 lakh rupees. It can be utilized for 5 years, but this company wants to utilize it only for 3 years. At the end of third year, it's going to sell the asset. When you go for leasing, you are going for leasing again for 3 years. One, discount rate is not same as after tax cost of debt, because interest rate is 13% into 1 minus tax rate will not be equal to 12%. Second, even if it was same, I can still not use the shortcut because taxes are paid 1 year in arrears. That is, first year you will have interest expense, but the tax benefit for that will come in the second year. Tax benefit for that is going to come in the second year. So that is how we will do this question. Working note 1, evaluation of loan option. 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 In that part 1, loan amortization table. Part 1, loan amortization table. Part 1 is loan amortization table. Loan amortization table. Is the repayment amount given in the question? They have said arrangement of a loan of 10 lakhs at an interest rate of 13%, loan being repayable in 3 equal year-end installments. So loan is repayable in equal. Some question will say principal is payable in 3 equal. If principal is payable means every time it is 1/3 of that. Loan is repayable in installment. Installment amount is equal to installment amount is equal to 10 lakh divided by PVAF 13%, 3 years. 10 lakh four lakh 23,549. 423,549 10 lakh divided by 2.361. 10 lakhs divided by 2.361, 423,549. That's the installment amount. Loan is repayable in end of year. If it's beginning of year installment, 1 plus PVAF R comma N minus 1. Now 4 columns, because the discount rate is different. Year, opening balance, interest, installment, closing balance. Year, opening balance, interest, installment and closing balance. Year, opening balance, interest, installment and closing balance. It will start from year 1. $10 lakh is the opening balance. I'll explain last year alone what needs to be done. Okay, this is how it will happen if I do 13%. Last year alone, I'll take interest as a balancing figure. I take interest as a balancing figure so that I get a 0. Last year, if I calculate, it is 48,716, but I'll take it as 48,808. If it's a huge value in the end, then there's something gone wrong. 92 rupees is fine. That's more of rounding of difference. On a 10 lakh base, 92 is fine. So last year we will take 48808. Clear? Part 2, present value of outflow of loan option. Present value of outflow of loan option. Present value of outflow of loan option. Broadly the same thing. Year, interest, installment, not principal. Year, interest, installment. Year, interest, installment, interest, installment. Depreciation, tax saving on interest plus depreciation, same format. Salvage value, net cash flow, PVF at 12% and DCF. Year, interest, installment, depreciation, tax saving on interest plus depreciation, salvage value, NCF, PVF at 12% and DCF. Earlier it was year, interest and principal, now we call it as interest and installment. Earlier it was interest and principal, now it's interest and installment. You will need a year 4, I'll explain why year 4 in some time. You will need a year 4. Interest copied from the earlier working note, installment copied, interest is copied, installment is copied, interest is copied, installment is copied, What is the depreciation rate? 40% WDV basis. So WDV is on the original cost you will charge it 4 lakh. Second year is first year into 1 minus depreciation rate, again into 1 minus depreciation rate. 4 lakh for the first year, 2 lakh 40,000 for the second year. It will not be cost minus residual value. Under WDV it's always on the cost. 10 lakh into 40%, 4 lakh into 1 minus 40%, 2 lakh 40,000 into 1 minus 40%. For second and third year you can take the shortcut, year 1 depreciation into 1 minus WDV rate. What's the tax rate given in the question? 35%. Now listen, it's paid in arrears. So what I'm going to do is, when I do in year 1 there is no tax saving. Year 1 there is no tax saving. Year 2 tax saving is year 1 interest plus depreciation into 35%. Year 1 interest plus depreciation into 35%. You are paying it 1 year in arrears, so the benefit comes in the next year. Year 1 interest plus depreciation into 35% into 35%. Into 35%. Any doubts on this? Come down. Computation of salvage value. WDV means you will have to compute the salvage value. It will not be same. Computation of net salvage value. Particulars amount, computation of net salvage value, particulars and amount, net salvage value. Point number 1 is sale value. Sale value. What will be the sale value of the asset after 3 years? Book value, $2,16,000, 10 lakh minus the depreciation for 3 years, 10 lakh minus depreciation of 3 years, capital loss. Capital loss 116, capital loss is 1,16,000, capital loss 1,16,000, tax saved 4,600, NSV NSV 140,600, NSV 140,600. Sale value is 1 lakh, book value is 216, capital loss of 116, tax saved of 4,600, and NSV is 140,600. NSV is 140,600. Any doubts on this? Okay, listen, the tricky part here is I'll be writing in year 3 1 lakh and the tax saved in year 4, because taxes are paid 1 year in arrears. Taxes are paid 1 year in arrears. So year 3 salvage value is 1 lakh, but the tax saved on loss will come in the year 4, and thereafter it's very simple. Okay, any doubts till now? Now listen, it's not interest plus installment, it's only installment because interest is already included in installment. Installment minus tax saving minus salvage value. Installment minus tax saving minus salvage value. Installment minus tax saving minus salvage value. Any doubts on this? The tax inflows or outflows will happen a year later. Present value of outflow of loan options 646,885. 646,885. 6,46,885. 646,885. The only thing is taxes have to be considered a year in arrears, so that's what we have done. 646,885. I cannot consider immediate tax benefit, so I have to wait for a year and then consider them. 646,885. Any doubts on this? Loan option is 646. Even if the discount rate and after tax cost of debt is same, it will not work because taxes are paid 1 year in arrears. Any doubts on this? Working note 2, evaluation of lease option. Any doubts on loan option? Loan is 646,885. 423 of year 1, 238 of year 2, 207 of year 3 and negative 108 for year 4. Evaluation of lease option, year, cash flow, PVF at 12%, DCF. Year, cash flow, PVF at 12% and DCF. Again it will be 4 years. 1, 2, 3, 4. Now listen, year 1 I will pay only rental. I don't get any tax benefit. Year 1 we pay rent but no tax benefit. Year 2 I pay rent and get the tax benefit of the first year. Get the tax benefit of the first year rental. Again I pay and get the tax benefit. Last 4th year only tax benefit. 4th year is only tax benefit. Only rental, rental plus tax benefit, rental plus tax benefit, only tax benefit. We'll go for loan option because leasing is costlier. 731 225 is the amount we get. So it turns out to be costlier. 731 225. First year only rent, second year rent and first year tax benefit, third year rent and second year tax benefit, fourth year only tax benefit. Any doubts in this? So I'll finally go ahead with, in this case we will go ahead with loan option. Leasing is not preferred, loan would be the preferred route because loan is cheaper than the lease option. Any doubts in this? Okay, sorry. Oh, this is wrong. Into point. In fact, it will go further up. Okay, it is 908188, 5,50,000, 65% of 5,50,000, 65% of 5,50,000, and negative 35% of 5,50,000. $908,188 is the answer to the lease option. 908,188. Any doubts on this? Clear? Can you proceed? Okay. So here we got 908,188 and 646,885. These were the two answers. Finally, you can write a conclusion. The company would go ahead with the loan option as the PV of outflow is lower. Final conclusion is company would go ahead with the loan option as the PV of outflow is lower. Any doubts on this? Okay, let's go to question 5. X Limited had only one water pollution control machine in this type of block of asset with no book value under the provisions of income tax, as it was subject to rate of depreciation of 100%. Due to funds crunch, X Limited decided to sell the machine, which can be sold in the market to anyone for 5 lakhs easily. Understanding this from a reliable source, Y Limited came forward to buy the machine for 5 lakh and lease it back to X Limited for a rental of 90,000. X Limited decided to invest the net sale proceeds in a risk-free deposit, fetching yearly interest of so much. It is also decided to retake the entire issue afresh after the set period of 5 years. Another company, Z Limited, also approached X Limited proposing to sell a similar machine for 4 lakhs to the later and undertook to buy it back at the end of 5 years for 1 lakh provided the maintenance were entrusted. X Limited would utilize the net sale proceeds of the old machine to fund this machine. The marginal tax rate is 34%, WACC is 12%. Which alternative would you recommend? Okay, at times what happens is I may have an asset in my place. So I have a car, but I am in a funds crunch situation. So what I would like to do is I will sell the car and take it back on lease. When I do that, initially I get some inflow, so that helps me in meeting my expenses, but when I take it back on lease, I have to pay some rentals every year. So in this case, I have a water pollution control machine. So due to funds crunch, I want to sell this for 5 lakhs. I'll sell it for 5 lakhs. I pay rental of 90,000 and I get some interest because I create a deposit. Another company, Z Limited, has also approached to X Limited for proposing to, in this case, they will sell a similar machine for 4 lakhs. In one, you do sale and lease back. In another, you sell and buy a new machine. Now we are deciding whether to do sale and lease back or sell and buy a new machine. That's the analysis which we are going to do. Working note 1, evaluation of sale and leaseback scenario. No, so first alternative is you sell the machine for 5 lakhs and take it back on lease. Second alternative is sell the machine for 5 lakhs and buy a new machine worth 4 lakhs. That's a different machine altogether. Why will I give lease? No, I don't need the machine. No. And due to funds crunch, X Limited decided to sell the machine, understanding this from a reliable source, and lease it back to X Limited. See, X Limited needs the machine. One, you sell it and take back the same asset on lease. Second, you sell it, and so I have a car, I sell the car and take the same car on lease. I sell the car and buy a new car. So I need car is needed for me. That is, there are no doubts on that requirement of a car. So this company needs water pollution control machine. Whether they sell it and take it back the same asset, or they sell it and take back some other asset, is the choice they are trying to make now. That's a choice which they are going to make. Working note 1, evaluation of sale and lease back. Evaluation of sale and lease back. Point number A, X Limited is in a cash crunch situation. X Limited is in a cash crunch situation, and hence they would sell, is in a cash crunch situation, and hence they would sell the machine for rupees 5 lakhs. They would sell the machine for rupees 5 lakhs. They would sell the machine for rupees 5 lakhs. Full stop. The asset is already fully depreciated. The asset is already fully depreciated. The asset is already fully depreciated. Is fully depreciated. And hence the company will have a capital gain of 5 lakhs. The company will have a capital gain of 5 lakhs. Company will have a capital gain of 5 lakhs. Next point, the company will receive a net amount of 3,30,000. Company will receive a net amount of 3,30,000 post tax payment of 1,60,000. Will receive a net amount of 3,30,000 post tax payment of 1,70,000. Any doubts till now? I have already fully depreciated this with no book value under the provisions of Income Tax Act. Now when I don't have any book value, entire amount is capital gain, and on that amount I will have to pay the tax. Next point, the company will create a fixed deposit. The company will create a fixed deposit for rupees 3,30,000. Will create a fixed deposit for rupees 3,30,000. Fixed deposit for rupees 3,30,000, and hence net cash flow for year 0, and hence net cash flow for year 0 is nil. Net cash flow for year 0 is nil. See, I'll sell the asset, get 5 lakhs, pay taxes of 170, left with 330. If I leave it as 330, then it is an inflow for me. But what I do is I use this to create a deposit. So net inflow is 0. Why do I create a deposit? It gives me some inflow over the year. Now year cash flow PV of DCF, year cash flow PV of DCF, year cash flow PV of, what is the rate, discount rate? 12? No, WACC. Yeah, 12%, last line, PVF DCF. Now listen, my cash flow for 1 to 4 is going to be same, or in fact I will write it as 1 to 5 itself and year 5 separately. What is going to happen in 1 to 5 is, 90,000 of lease rent. 90,000 of lease rent is my outflow. I'll put outflow in negative. 90,000 of lease rent is my outflow. In this problem, outflows are negative. We'll understand why in some time. 90,000 of lease rent. You will get 3,30,000 into 8.75% of lease fixed deposit interest. 3,30,000 into 8.75%. So income is 330 into 8.75%. Expense is 90,000. Net you will spend money. Net you are going to spend money into 66%. Why 66 is after tax? Into 66%. This is going to be my net outflow every year for a period of 5 years. 90,000 minus 90,000 plus 3,30,000 into 8.75%. 330 into 8.75%. 330 into 8.75% into 0.66. So every year 40,343 will go from my pocket. Every year 40,343 will go. Every year 40,343 is the outflow. So write year 1 to 5, 40,343 is the outflow. 40,343 is the outflow. Every year this outflow is there. 40,343. 40,343 is the outflow every year. You want to show calculation, you can show it. It's 90,000 of lease rent, 330 into 8.75% of interest income, net loss or net expense into 66%. In year 5, I have to close the calculation at year 5. In year 5, I'll get back this FD of 3,30,000. I'll get back this FD of 3,30,000. I'll get back this FD of 3,30,000. So I pay 40,343 for the first 5 years and get back an FD of 3,30,000. This may give me a positive NPV or a negative NPV. You can do that calculation. Which one? I'll come to it. Let me complete both the analysis. See, if I evaluate sale and leaseback on a standalone basis, it's good to do this because you will use the asset for 5 years. You will pay only 40,343 and you will get back 330. In fact, I can even structure it in such a way that from the FD, I'll keep redeeming 40,000 every year. If I keep redeeming 40,000 every year, redeem 40,000, pay the first year amount. Second year, the requirement can be slightly higher because interest will come down. You redeem maybe 42, you redeem 48. You'll be left with some money still at the end of 5th year. You'll be still left with some money at the end of 5th year. So it's anyway a beneficial thing to do sale and lease back. Now I also have another option in hand, which is going with Z. So let's see what happens if we go with Z. Next, working note 2, evaluation of offer of Z limited. Evaluation of offer of Z limited. Evaluation of offer of Z limited. Point number A, the company will sell the machine. The company will sell the machine for rupees 3,30,000. Will sell the machine for rupees 3,30,000. For rupees 3,30,000 and buy a new machine. For rupees 4 lakhs. Buy a new machine for rupees 4 lakhs. Buy a new machine for rupees 4 lakhs. full stop. The initial outflow therefore would be 70,000. The initial outflow therefore would be 70,000. Okay, in a sale and leaseback, I don't become the owner again, so I don't claim depreciation. Here, I become the owner because I'm buying the machine, and the question says, it is subject to rate of depreciation of 100% in the very first year of installation. So, this is some asset which you buy. In the first year itself, you can claim the entire amount as depreciation. Point number 2, the company will claim a depreciation of 4 lakhs in year 1. The company will claim a depreciation of 4 lakhs in year 1. 4 lakhs in year 1. And it will have a tax benefit of rupees 1,36,000. Tax benefit of rupees 1,36,000 in bracket 4 lakh into 34% in year 1. Tax benefit of rupees 1,36,000 in year 1. Any doubts on this? So, I sell the asset, I get 330, I buy the machine for 4 lakhs by bringing 70,000 from sources. Some sources I have to bring that 70,000. I get a tax benefit of 136 at the end of year 1. Any doubts on this? Now, year cash flow PV of DCF. Year cash flow PV of DCF. Year cash flow PV of DCF. Year 0 negative 70,000. Year 0 negative 70,000. Year 1 1,36,000. 1,36,000. Year 1 1,36,000. Now, apart from this, there is some maintenance to be paid. They have mentioned something. How much is the maintenance to be paid? Yearly charge of 15,000. So, maintenance is not 15,000. 15,000 into 66%. 15,000 into 66%. This is negative because it's outflow. 15,000 into 66%. Year 0, I get 70,000. Sorry, I pay 70,000. Year 1, I get back 136. And 1 to 5 years, there's a 9,900 ka outflow. 9,900 outflow. Yeah, you have to pay to the other guy. He's saying no, okay, I will give you the machine. Okay, in fact, there is one more item. Sorry, there's one more item. I'm just seeing it. He is saying, provided the maintenance were entrusted to Z Limited at a yearly charge of 15,000. At a yearly charge of 15,000, they've mentioned that you have to give it. The Z Limited will buy the machine at 5 lakhs, give you a new machine at 4 lakhs, provided you give some maintenance to them. Okay, one more thing is, at the end of 5th year, I'll sell this machine for 1 lakh rupee. 1 lakh means I'll get only 66,000. 1 lakh means I'll get only 66,000. Capital gain is the balance portion. 1 lakh is, you will get only 66,000. So in case of this, I sell the asset. If you're able to visualize the transaction, it's easy to understand the problem. I sell the asset for 330, buy a new asset for 4 lakhs, so 70,000 paid. At the end of 1 year, I depreciate and get the benefit. For 5 years, I pay maintenance of 9,900. At the end of year 5, I sell it for 66,000. That's the crux of the question. You can write finally answer. The company should go ahead with option 2. The company should go ahead with option 2 in bracket Z Limited's offer. The company should go ahead with option 2 in bracket Z Limited's offer. Should go ahead with option 2 Z Limited's offer. So I will sell my old asset and buy a new asset in that place. Clear? Any doubts on this? Can we proceed? Let's move to the 6th question. Go through the question. Please go through the question. Okay. Now, R Limited wants a machine for 5 years. There are two alternatives, either to take it on lease or buy. Company doesn't have money, so they approach their bankers. Bankers are ready to finance 100% at 15% rate of interest. Under lease option, upfront security deposit is 5 lakh is payable to the lessor, which is equal to cost of the machine. Normally in lease option we have only 4 columns: year, cash flow, PVF, DCF, and we are done with it. In this question, lease will also include a loan. Lease will also include a loan because I have to create an upfront security deposit of 5 lakhs. How do I get that 5 lakhs? I get that 5 lakhs only through a loan route, out of which 40% shall be adjusted equally against annual lease rent. So whatever the lease rent they are saying, of that 40% will get adjusted and 60% needs to be paid. At the end of the life, expected scrap value will be at the book value after providing depreciation at 20% on written down value basis. In fact, this information is not for lease, it's for loan. They are saying expected scrap value will be at book value after providing, you cannot provide depreciation if you are going through a lease route. Under buying option, loan repayment is in equal annual installments of principal amount. Then it's not installment, it is equal principal, equal annual installments of principal amount, which is equal to annual lease rent charge. So they're saying lease rent and annual principal is same. In case of bank finance for lease option, repayment of principal amount equals to lease rent adjusted every year and the balance at the end of 5th year. I'll explain this when I do the question. Assume income tax rate, interest is payable, discount rate is 15% per annum. So discount rate is not same as after tax cost of debt. The discount rate given in the question is 15%. So when you evaluate the loan option, you have to do a detailed calculation. Lease option anyway is going to be detailed in this question, because the question says there is some loan to be taken even in case of lease option. Working note 1, evaluation of loan option. Working note 1, evaluation of loan for buying. Evaluation of loan for purchase of asset. Any of the alternatives, you have in both the alternatives you need a loan, unfortunately. In lease, I need a loan because he is telling me to create an upfront security deposit of 5 lakh. In the lease, I have to create an upfront security deposit of 5 lakh. In loan, I have to anyway buy, see, if I am going to create a security, if I had the money to create a security deposit of 5 lakh, I as well could have bought the asset. So in both the cases, I need a loan. In both the cases, I have to take the help of loan. Most probably lease will get rejected, because in lease you are creating a security deposit of 5 lakhs. You don't get any depreciation benefit, you don't get the salvage value benefit. Most probably lease option will get rejected here, because that upfront security, there will be upfront security deposit, but it can't be 5 lakh, it can be maybe a lakh or 50,000, that is fine. But a security deposit of 5 lakh is huge. Security deposit of 5 lakh is huge. So most probably it may get rejected. Evaluation of loan for buying option. This nothing changes, it's same as what we have been doing. Part A, loan amortization table. Loan amortization table. Year, opening balance, interest, installment and closing balance. Year, opening balance, interest, principal, sorry. Principal and closing balance. Year, opening balance, interest, principal and closing balance. Now see the wordings. It said bankers are ready to finance just a minute. Under buying option, loan repayment is an equal annual installment of principal amount. If they just say equal annual installment, then it's 5 lakh divided by PVAF R comma N. They said equal annual installment of principal, which means equal principal. Equal principal. So 5 lakh is the original loan. Rate of interest is 15%. Rate of interest is 15%. And principal is going to be 1 lakh. Equal principal. Equal principal, it's going to be 1 lakh. Again principal is 1 lakh. As far as buying is concerned, nothing changes. It's only in the lease they have brought in some complexity. In buying option, nothing is changing. Opening balance, interest, principal and closing balance. $5 lakhs, 1 lakh is the principal for each of the 5 years. You repay interest of so much and closing becomes 0. Any doubts on the loan amortization table? Part B. PV of outflow. The structure remains the same. Year, interest, principal, depreciation, tax saving on interest and depreciation, salvage value, NCF, PVF, DCF. Year, interest, principal, depreciation, tax saving on interest and depreciation, salvage value, NCF, PVF, DCF. Five years, copy paste interest and principal. Copy paste interest and principal. Interest and principal is copied. What have they mentioned about depreciation? 20% WDV. So 5 lakh into 0.2. Next year onwards, first year depreciation into 0.8. That's the shortcut. First year is 5 lakh into 20%. Next year onwards, first year into 80. Into 80 into 80, you can keep doing that. The formula is year 2 depreciation is equal to year 1 depreciation into 1 minus WDV rate. What's the tax rate? How much? Okay. Interest plus depreciation into 0.3. Interest plus depreciation into 0.3. Interest plus depreciation into 0.3. Nothing changes as far as loan option is concerned, that is buying option is concerned. It's only in the lease where we bring in a little bit of complication. My salvage value is, good part is they are saying salvage value will be equal to book value, and they are saying it will be whatever is the cost of asset minus the 5-year depreciation. Cost of asset minus the 5-year depreciation, and it will be equal to that. Book value and sale value is going to remain same. 163,840. 163,840. NCF is interest plus principal minus tax saving minus salvage value. The loan option, nothing changes. It's where the lease we bring in a little bit of extra complications. $297,485 is the outflow in loan for buying option. If you take a loan and buy an asset, we will pay $297,485. Clear? Okay. Now I'm going to evaluate the lease option. Lease option used to be very simple till now. In this problem, you are going to see like extra complication. Working note to evaluation of lease option. Evaluation of lease option. Part A, loan amortization table. Part A, loan amortization table. Part A, loan amortization table. Okay, now listen. Under lease option, upfront security deposit of 5 lakh is payable to lessor, which is equal to cost of the machine. So I'll have to create a deposit of 5 lakhs. How do I create a deposit of 5 lakhs? By taking a loan of 5 lakhs. Out of which 40% shall be adjusted equally against annual rent. That is, of the 5 lakhs, 40% is 2 lakhs. In that 2 lakhs, they are saying every year you will adjust 40,000. That security deposit is given because he is saying don't pay the rental. When you have to pay the rental, we will adjust 40% of that. We will adjust 40% of that. Other thing they are saying is, in case of bank finance for lease option, repayment of principal amount equals to lease rent adjusted every year. Equals to lease rent adjusted every year. Of the 5 lakh security deposit, 40% is adjustable. 40% is adjustable, which is 2 lakh rupees. Of that 2 lakh rupees, every year 40,000 will get adjusted. That is, if I have to pay a rent of 1 lakh, I will not pay rent of 1 lakh, I will pay only 60,000. I'll pay only 60,000. So my principal payout every year is going to be whatever is the amount getting adjusted. They are saying whatever is, so 40,000, 40,000, 40,000, 40,000, and in the end I'll pay. This is how I'll repay the loan. The principal amount is equals to lease rent adjusted every year. Principal amount is equal to lease rent adjusted every year. You will understand the importance of this when I do the next working note. Equals to lease rent adjusted every year. So 40,000 in the first year, 40,000 in the second year, 40,000 in the third year, 40,000 in the fourth year, and 3,40,000 in the fifth year. The only issue is I'll have to pay interest of so much extra. So do this loan amortization table. 40,000 for 4 years and 3,40,000 in year 5. 40,000 for 4 years and 340 in the last year. Normally there will not be a loan, but in this case I am forced to take a loan because I have to create an upfront security deposit. So for creating that upfront security deposit, we took a loan and we are repaying amount which is getting adjusted every year. Whatever amount which is getting adjusted every year is repaid. Any doubts in this? Now write note. The company creates an upfront security deposit of 5 lakhs, creates an upfront security deposit of 5 lakhs, creates an upfront security deposit of 5 lakhs, full stop. 40% of the amount, 40% of the amount is adjusted, 40% of the amount is adjusted, is adjusted while paying lease rental, is adjusted while paying lease rent. Next point, annual lease rent adjustment is equal to, annual lease rent adjustment is equal to 5 lakh into 40% divided by 5 years. Annual lease rent adjustment is equal to 5 lakhs into 40% divided by 5 years. 5 lakhs into 40% divided by 5 years, which is 40,000. Any doubts in this? Okay. Now comes the tricky part. Listen. I'm going to do PV of outflow. Listen for some time. Interest I have copied. Principal will not come. I'll explain why it will not come in some time. Lease rent. Every year I have to pay a lease rent of 1 lakh. Lease rent is 1 lakh. They have said lease rent is loan repayment is an equal annual installment, which is equal to annual lease rent charges. So lease rent is 1 lakh. There can't be any depreciation. Tax saving on interest and lease rent. I'll explain why I'm not writing principal in some time. Interest plus lease rent. There's no salvage value here. So my net outflow is okay. Now listen, I am required to repay principal every year. Now what is going to be principal is, listen, I create an upfront security deposit of 5 lakhs. In the first year, I am required to pay a lease rent of only 60,000. I am required to pay a lease rent of only 60,000. Why I write 1 lakh is because I can calculate the correct tax benefit. Now you can understand it like this, that you pay 1 lakh of lease rent, he gives you back 40,000. That's neither an income nor an expense, it's a balance sheet item. He gives you back 40,000. You take that 40,000 and give it to the bank. You take that 40,000 and give it to the bank. So your principal is paid out of the LR adjustment. Second year he gives you 40, you pass on to the bank. Third year he gives 40, again you pass on to the bank. Fourth year he gives 40, again you pass. Fifth year he has to give you 340, the entire amount, and you pass it on to the bank. So principal will get paid out of the lease rent which is adjusted. So what you are required to pay out of the pocket is interest and lease rent. Lease rent will be entire 1 lakh. Why I write 1 lakh? So that I calculate the correct tax benefit. I end up calculating the correct tax benefit. If you write 60,000, you'll end up making a mistake in the tax benefit side. Correct.
So it will be 60 plus 40 and adding 3.
Correct, yeah. So practically you will do this only, but in your books of accounting you will say 1 lakh as lease rent expense. Yeah, 40,000 as receipt of security deposit and 40,000 as payment of principal.
Then in the 5th year, I am paying only 1 lakh. Apart from that, I have been paying 3 lakhs.
So 3 lakh 40 is principal. He will give you back 340. No, you gave a security deposit of 5 lakh rupees.
Okay.
That security deposit has to come back. So he will give you back that 340 and you pass it on. So your job is just to collect the money from here and pass on. But the problem is, in all this process, I had to pay interest of so much. I am forced to pay interest of so much. So this is the calculation. Year, interest, lease rent. I'll give a note why principal is ignored in some time. Year, interest, lease rent, tax saving on interest and lease rent, NCF, PVF and DCF. Only thing is, take care of tax. Tax part, if you end up making a mistake, it becomes a problem. Otherwise, it's fine. Whatever way we want to show. Which one? It's copied from your earlier calculation. The problem is, I take a loan, I don't get salvage value benefit, I have to pay interest. So all of that is a pain in this company for the leasing option. Any doubts on this? Now write repayment of principal payment. Principal payment is not considered. Principal payment is not considered in the above cash flows. Principal payment is not considered in the above cash flows. In the above cash flows, as the same would be paid out of part adjustment of security deposit. Would be paid out of part adjustment of security deposit. Paid out of part adjustment of security deposit. Part adjustment of security deposit. Clear? Any doubts on this? You can finally write a conclusion. The company should go ahead with buying option. The company should go ahead with buying option as the PV of outflow is lower. Should go ahead with buying option as the PV of outflow is lower. Should go ahead with buying option as the PV of outflow is lower. Clear? Any doubts on this? Go through 7th question. Okay. A company has received 3 proposals from leasing companies for the acquisition of an asset costing 1,50,000. Option 1, payment of rental for 96 months. First is 72 month, lease rent is 30 per month per rupees 1,000. So if the cost is 1,000, they are saying rental is 30 rupees, cost is 1,50,000, so rental will be based on that. And during the remaining months at 5 per month, on the expiry, the lessor has offered to sell the asset at 50% of the original cost. So that's an option. Whether we choose or not, we'll see in some time. Option 2, 72 months only. They have given differential rentals. Option 3 is the lease will be signed for a period of only 60 months. You will have to create an initial lease deposit. Lease rental of 35 per month will have to be paid, and on the expiry of the asset will be sold against the initial deposit, and the asset is expected to last for a further period of 3 years. You are required to evaluate the proposal keeping in view the following parameters: SLM, discounting rate, tax rate. Now listen, in this case, lease rental is going to be paid every month. Lease rent is going to be paid every month. So we have something called as a monthly discounting factor. Something called as a monthly discounting factor. What is monthly discounting factor? Is 1 divided by 1 plus 1.25 percentage. 1 divided by 1 plus 1.25 percentage. 1.25 percentage is for a month. You do it for the first month, second, third, fourth till 12 months, and if you take an average of that, that will be 0.923. That will be 0.923. So the lease rent is paid every month. So one, if I do, we have 12 months. If I do the first year calculation, it's basically 1 divided by 1.0125. So this is what is going to be the factor if I have to take monthly, and an average of this is 0.923, which is what you see. So this is basically not year 1, this is basically 1 to 12 month. This is 13 to 24 month, 25 to 36 month, 37 to 48 month, but they have given the average of it. Now the only thing is they also have a yearly discounting factor. So what we are required to do is, we will do like this: year, lease rent, monthly discounting factor, present value of lease rent, tax benefit will be multiplied with yearly discounting factor. Tax benefit will be multiplied with yearly discounting factor, because tax benefit will come at the end of the year. That's the only difference we have here. How those 0.923 is computed is 1 divided by 1 plus 1.25%. You keep doing for 12 months and take an average of that. Working note 1, evaluation of option 1. Evaluation of option 1. Evaluation of option 1. Year, lease rent, monthly discounting factor at 15%, monthly discounting factor at 15%, tax on LR, yearly discounting factor at 15%, finally DCF, year, lease rent, monthly discounting factor at 15%, tax on lease rent, yearly discounting factor at 15%. Now the terms of the offer envisage payment of rentals for 96 months, first 72, then balance 24. On the expiry, lessor has offered to sell the asset at 50% of the original cost. Listen, I don't know what is going to happen after 96 months. He has offered, and our assumption is we have declined this offer, because if I buy this asset, then I need to know what is going to happen after 96 months, because what is going to happen with the asset, without knowing that I cannot agree to this offer. So we will finally write a note. So it's only 8 years cash flow, 8 years cash flow, 8 years cash flow. Can you tell me what will be the lease rent of the first year? First year, what should be the lease rent? Anything else? No, that is okay. Okay, it will be, listen, whatever you have said broadly is fine. 1,50,000 divide by 1000 into 30. I'll have to do into 12, because that monthly discount factor is average of 12 months. If it's cumulative amount, then you need not do into 12 here, because there I have divided by the factor by 12. So I'll have to write into 12 here. 54,000 is the rent. 1,50,000 divided by 1000 into 30 into 12. This will happen for 6 years. 150 by 1000 into 30 into 12, and last 2 years is only 5 rupees. The last 2 years is only 5 rupees. You can copy the factors from the question. The lease rent is paid monthly, so you will discount with a monthly factor, and tax on lease rent will be at yearly discounting factor. Factors are copied from the equation. The DCF number is LR into monthly discount factor minus tax on LR into yearly discounting factor. Tax on LR is a saving. Lease rent into monthly discounting factor. Lease rent into monthly discount factor minus tax on lease rent into yearly discount factor. Lease rent into monthly discounting factor, tax on lease rent into yearly discounting factor. A lot of authors will say the tax benefit also will come on a monthly basis, so both could have been clubbed together. One 134,813. 134,813. That's the option 1 number. 134,813. Evaluate option 2. I'll take you through option 3 that has certain adjustments. Option 2 is a fairly simple one. It's a 6-year lease. 134,813. Any doubts on option 1? Do option 2. It's a 8-year problem. Eight-year computation. There's no hidden adjustment there. Option 3 has a little bit of an adjustment. First year is 1,50,000 divide by 1000 into 35 into 12. 30 rupees. 26, 24, 22 and 20. Any doubts on this? Can you proceed to option 3? Option 2 is fairly simple. Evaluation of option 3. Option 3. Okay, when it comes to option 3, it will start with year 0. Option 3 will start with year 0. Listen for a minute. Option 3 will start with year 0. What they are saying is, under this offer, a lease agreement is proposed to be signed for a period of 60 months. 15% will be made at the beginning. 15% initial lease deposit. 15% is 15% of the cost of the asset. So I'll pay 22,500. This is not technically lease rent. This is my deposit which I make. Then I'll have to pay lease rent at the rate of 35 per month. On the expiry of the leasing agreement, the asset shall be sold against the deposit. So this deposit will not come back. In place of deposit, the asset is going to come, and you will use the asset for 3 years. So in year 6, 7 and 8, no lease rent, but there is going to be depreciation benefit. There is going to be depreciation benefit. 1 to 5 you will pay lease rent and tax benefit on lease rent. 6, 7 and 8 you will claim depreciation, tax benefit on depreciation. Clear? Any doubts on this? So we will start with year 0. We will start with year 0. In year 0, there is going to be a lease rent or a deposit of 22,500. There is going to be a deposit of 22,500. 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 After I give this deposit of 22,500, I'll have to pay 1,50,000 divide by 1000 into 35 into 12. 150 divide by 1000 into 35 into 12. I'll pay this for 5 years. I'll pay this for 5 years. I'll pay this for 5 years. $63,000 for 5 years. 63,000 for 5 years. $63,000 for 5 years, and you will have something called as year 6, 7 and 8 is depreciation is 7,500, but what matters is the tax benefit on that. Year 6, 7, 8, 22,500 by 3, the deposit which you have created is converted as the book value of the asset, 7,500 into 40%, and this is the overall amount. 6, 7, 8, you had created a deposit of 22,500 that doesn't come back, asset comes back. On the asset, you will claim depreciation of 7,500 every year, which is effectively 3,000 of tax saving. Any doubts on this? Now, first one is a 8-year option, second one is a 6-year option, and the third one again is a 8-year option. So we will need EAC to proceed. For EAC, we will take the yearly discounting factor itself. We are calculating the annual cost. So if I do monthly, equated monthly cost, I'll take the monthly factors. Next working note, computation of equated annual cost. Computation of equated annual cost. Particulars option 1, option 2 and option 3. Particulars and 3 options. Particulars and 3 options. PV of outflow. PV of outflow PV of outflow, PV of outflow, life, PVAF R, life, EAC. This was 8 years, 6 years, 8 years, So we'll go ahead with option 3. That's the best option. That gives you the that has the lowest equated annual cost. Any doubts on this? Clear? Let's move to question. The last question will take a little bit of time. Go through this question. Go through question 8. Go through 8 and start doing the first one. I'll take you through from the sensitivity part. Try doing the first one. discount rate will be equal to after tax cost of debt. So loan option will be in 3 steps, but in that depreciation benefit will involve a working note. It's WDV method. So depreciation won't be that straightforward. You will have to do a working note for that. Okay, the cost of the asset was 10 lakhs. Depreciation is not an easy thing, so you will have to do a separate working note for depreciation benefit. Note 1. Year depreciation tax benefit PVF DCF 5 years 10 lakhs into 33%. Tax, no, depreciation is 33%. Okay, sorry, 25%. 25%. Next year is first year into 75%. Goes on like this. The discount rate would be 1 minus after tax cost of debt, which is 12 into 67%. This is how your depreciation tax benefit would be. I hope this is what you have done. PVF is at 8.04%. 12 into 67%. 12 into 67%. Yeah, 8.04. PVF is at 8.04. And the DCF is it used to be a very simple statement. In this problem it's a little complicated because we have to follow WDV method. So WDV method will give you 209494. Then I also have to do salvage value computation, which is also not going to be straightforward. Again I'll have to do particulars amount. We have sale value less book value. Sale value is, how much is the salary? 67,000. Book value is 10 lakh minus so many years of depreciation. So you are left with 237. Capital loss, tax saved into 0.33, and NSV is 123,200. NSV is 123,200. You will write 123,200 into the fifth year factor, which is 0.679. 83,653. 133,200 into 0.679. 123,200 into 0.679. 0.679. Correct. Tax saved is 33,200. Sale value minus tax saved. Correct. So what have I done? Correct, no? 67 plus 56. 67 plus 56. The logic is sale value plus your save tax. When you save tax, it will be an inflow. $83,653 present value of outflow of loan option. $706,853 outflow of loan option. 706,853. Any doubts on the loan option? Then lease is simpler. Lease option evaluation. The important part is the second part, which is sensitivity analysis. Lease option evaluation. The problem is silent, so my discount rate is after tax cost of debt. One to five. One to five. 2,70,000 into 67%. I'll then explain the sensitivity part, which is the critical one. It'll take a little bit of time to go through that. Loan is 706, lease is 721. Loan is 706, lease is 721. Any doubts in this? Okay, I am going to prefer loan option now. I'm going to prefer loan option because I have a lower outflow there. Now they are saying measure the sensitivity. The formula for sensitivity is change by base into 100. That is what we have done in sensitivity analysis. Change by base into 100. For rate of borrowing, they want the sensitivity. Residual value, they want the sensitivity. Initial outlay, they want the sensitivity. Listen, first part is sensitivity basically means there is going to be a reversal of the decision. Whatever decision you are taking, it will reverse. That is what sensitivity means. Today, what is the decision we are taking? Loan. I'll first find indifferent residual value. Indifferent residual value means the value at which both will give me the same results. Then indifferent initial outlay, the value at which both will give me the same results. And then finally, we'll do indifferent rate of borrowing. So I am going to find the indifferent one. Once I find the indifferent one, we'll use a formula called as change, because beyond the indifferent one, you will opt for the other decision. At the other side of the indifferent one, you opt for this decision. So we are going to calculate the indifferent. Next working note, sensitivity analysis on residual value. 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 Particulars and amount. Sensitivity analysis on residual value, particulars and amount. Okay, first question, when a residual value changes, will anything change here? Lease option evaluation. If I change the residual value, would anything change here? Residual value, why will PVF change? Salvage value, no. Nothing is going to change, so I'm not going to come to this, okay. When it comes to loan option, line 1 no change, line 2 no change, line 3 alone is going to change. Line 3 alone is going to change, and we will make this value to be equal to 721,610. We want it to be 721,610. So point number 1, cost of the asset. Cost of the asset. $10 lakhs. Cost of the asset 10 lakhs. Present value of depreciation benefit. Present value of depreciation benefit minus 209,494. 209,494. Salvage value in bracket note 3. Salvage value in bracket note 3. The only thing which I know is it should add up to 721,610. It should add up to 721,610. This is the only thing which I am aware of at this point of time. I want this to add up to 721,610. Any doubts in this? Okay. Now coming to note 3. Sale value X rupees. The residual value is going to be X. Sale value is X. Book value is going to be 237 304. Sale value is X rupees, book value is 237 304. I'm also not sure whether it's going to be a capital gain or a capital loss. So what we will call it as is, I'll call it as capital gain itself. If it is turning out to be negative amount, it will automatically become capital loss. X minus 237 304. Capital gain X minus 237 304. And my tax on capital gain is 0.33 NSV sale value minus tax on capital gain. As of now, I assume this is an outflow, but if it's an inflow, automatically minus sign will take care of it. .67x plus 78,310. 0.67x plus 78,310. I'll copy this. Okay, this is NSV. Okay, I'll tell you a short way of this NSV. NSV is nothing but 67% of sale value and 33% of book value. It's always that way. Whatever is the tax rate into book value plus 1 minus tax rate into sale value. When both used to be same, it will effectively become 67% of sale value plus 33% of sale value if both are same. Effectively, NSV is nothing but 67% of sale value plus 33% of book value. And present value of NSV is the discount rate was 0.679. So 0.679 is 0.67 into 0.679, 0.455x .455x plus 53,172. 0.455x plus 53,172. Now I'll go back to this table. 0.455x plus 53,172 plus 53,172 Any doubts on this? You go back to this, again this has to be subtracted. 0.455x plus 53,172. In place of this x, if you substitute 67,000, it should add up to the earlier number, which is 706,853. If you substitute, it should add up to that. If it's not happening, some mistake. If I substitute 67,000, I'll get this 83,653. So it matches to that. It will match to that. Now you equate this and tell me what do you get as x. Then you will have to equate again.
The balancing figure is nothing but present value, which is 0.67. I converted it to the whole of 1.
The present values?
I got the balancing figure, which is 10 lakh minus.
ठीक है, whatever is the balancing figure.
That divided by 0.679.
Correct.
I'll be getting that figure.
Correct.
That is equals to 0.676 plus 7.
Correct. That's you'll get the same answer. $10 lakh minus 209,494 minus 0.455x minus 53,172 is equated to 721,610. At this residual value, a decision reversal will happen. You will end up revising the decision. I get it as 34,558. Some up down rounding of difference can be there. 34,558 is a broad number I get. 34,558. 34,558. Okay. Any doubts on this? Now the sensitivity percentage on residual value is sensitivity on residual value is change by base into 100, 67,000 minus 34,558 divided by 67,000 into 100. That is, if my residual value falls by this percentage, a decision will get reversed. We have some 48% question here. The sensitivity basically tells change by base into 100. So we have a cushion of 48.52%. 48.52%, 42%. Any doubts on this? This was an easier one, which is on the residual value. We assume the residual value as X and then done all the calculation. Okay, listen now. I'll go to the cost of the asset part. The second sensitivity, interest will be the last one. Why interest last, you will understand in some time. I'll go to the cost of the asset now. Listen, when it comes to cost of the asset, will anything change here? No. Okay, I don't know my cost of asset. Okay, today I have my cost of asset as 10 lakh. Let's assume, just for an imaginary sake, this is not 10 lakh and this is 20 lakh. This is 20 lakh. The depreciation benefit has exactly doubled. The depreciation benefit has exactly doubled. So what I am going to do is, I'll take this as X. This as X. The depreciation benefit is going to be minus 0.209494x. Whatever be the cost, if 10 lakh is the cost, benefit is 2,09,494. If cost goes down, benefit goes down. If cost goes up, benefit goes up. Clear? Any doubts on this? I don't know what is that cost. So the cost is X rupees. The depreciation benefit is 20.9494 of the X. 20.9494 percentage of the X. Any doubts on this? Okay. When it comes to this, my sale value will be 67,000 and book value is going to be 0.237304x. 0.237304x. Why it is 237304x is, if value goes up, book value will also go up. If value comes down, book value will also come down. So you will get the NSV, put it there and we equate again. Clear? Any doubts on this? Now write sensitivity analysis on initial cost. Sensitivity analysis on initial cost. Let us assume the initial cost to be X. Let us assume the initial cost to be X. Let us assume the initial cost to be X. Initial cost to be X. Next point, the company had a original cost of 10 lakhs. The company had a original cost of 10 lakhs. Had a original cost of 10 lakhs. Had a original cost of 10 lakhs and the present value of depreciation benefit was 209,494. Present value of depreciation benefit is 209,494. Full stop. If the cost is X, if the cost is X, if the cost is X, then present value of depreciation benefit, present value of depreciation benefit is 0.209494x, is 0.209494x. Any doubts on this? Clear? Next point, the book value after 5 years, the book value after 5 years is 237,304, is 237,304, is 237,304 for a cost of 10 lakh, for a cost of 10 lakh. Full stop. Similarly, if the cost is X, similarly if the cost is X, if the cost is X, if the cost is X, then book value would be 0.237304x. Book value would be 0.237304x. Any doubts on this? Next, present value of loan option is computed below. Present value of loan option is computed below. Present value of loan option is computed below. Loan option is computed below. Particulars and amount. Point number 1, cost of asset X, cost of asset X, present value of depreciation benefit, present value of depreciation benefit, $209,494X, 209,494X, 209,494X. Okay, I'll directly write the salvage value. What is salvage value is, it is 0.679, 67% of sale value plus 33% of book value. 67% of sale value, I'll use that short way, 67% of sale value, which is 67,000, 67% of sale value plus 33% of book value, 0.237304, %67 of sale value plus 33% of book value, 67% of sale value plus 33% of book value, %67 of sale value anytime. It will automatically take that into consideration. That is, I did, if you do 40,000 here, you will have capital gain. So it will say 67% of this plus 33% of this, 58090. You can even make it as 1 lakh. 1 lakh means it's a loss scenario. It will again pick up 67% of sale value plus 33% of book value. I'm going to equate this to 721,610. If you substitute 10 lakhs in place of X, you should get 706,853. That should be 706,853. We're going to substitute 10 lakhs. If you substitute in place of X 10 lakh, you should get the earlier number. What happened? Seven three seven three X. In that 7373, if you substitute 10 lakhs and subtract 30,480, you will get it as 706,820, which is the earlier number, 706,853. So 7373x minus 30,480. I have to equate it to 721,610. I am equating it to 721,610 so that I find at what level it is going to be indifferent. At what level an indifference is going to come. So the cost can even go up to 10,20,060. It can go up to this level. Till this, I am still okay with the loan option. Anything beyond this, lease will be taken into consideration, because if cost of the asset goes up significantly, lease will look better. 10,20,060, 10,20,060. Sensitivity percentage is equal to change by base into 100. Sensitivity percentage is equal to change by base into 100 so it has a question of only absorbing 2% change. If the cost of the asset goes up by more than 2%, project is over. You can't do much about it. Any doubts on this?
If it is more than 2, I will be going for lease.
There it was, if the change is downward change, anyway it's a downward change, there it's a downward change, here it's a upward change. Any doubts on this? Okay, interest rate is very tricky. Now look at, they say rate of borrowing. What is the current rate of borrowing? 12. I'll increase it to 14 and check now. When I increase it to 14, I'll have to only increase and see. I cannot assume X. The problem is when interest rates change, this will also change. When interest rates change, this will also change, because the discount rate is going to undergo a change. So as of now, I can call it as Npv of buying option. Npv of buying option is 721,610 minus 706. Buying is better by 14,000. If you increase the interest rates, you may get a negative NPV. If you increase the interest rates, you may get a negative NPV, one positive, one negative, to calculate the IRR. And that IRR is basically the rate at which both will be same. IRR is the rate at which both will be same. Next, sensitivity analysis of rate of borrowing. Sensitivity analysis of rate of borrowing. Point number 1. Any change in rate of borrowing, will also impact, any change in rate of borrowing will also impact the lease option, as the discount rate is after tax cost of debt. As the discount rate is after tax cost of debt. As the discount rate is after tax cost of debt. Next point. For a discount rate of for an interest rate of 12%, for an interest rate of 12%, loan option has an NPV of, for an interest rate of 12%, loan option has an NPV of 14,757. loan option has an NPV of 14,757 in bracket 721,610 minus 706,853. 721,610 minus 706,853. Any doubts on this? Next point. We will increase the interest rate to 12%. We will increase the interest rate to 14%. We will increase the interest rate to 14%. Interest rate to 14% and evaluate both lease and loan. Evaluate both lease and loan. Evaluation of loan option. Evaluation of loan option. Evaluation of loan option. Particulars and amount, because discount rate will be same as after tax cost of debt, we'll use the shortcut method. Particulars and amount. Point number 1, cost of the asset. Cost of the asset. You can write 10 lakhs. I'll tell you to copy certain numbers because it's not going to be of any learning. The discount rate is not going to be 8.04 now. It's going to be 14 into 67%. 14 into 67%. So it is going to be 9.38, and when I do 9.38, everything will remain same. I just need to do discount rate of 9.38. So you can write present value of depreciation is 203,596. At 9.38%, it's 203,596. 203,596. At 9.38%, it's going to be 203,596. 203,596. Any doubts on 203,596? Less present value of salvage value. Less present value of salvage value. Less present value of salvage value in brackets 123,200. 123,200 into PVF 9.38% and 5 years. Present value factor 9.38% and 5 years. 9.38% and 5 years. I didn't want to repeat the depreciation calculation. 123,200 into 9.38% PVF for 5 years. The loan from 706,853 changes to 711,781. Overall outflow changes to 711,781. But that's not the only point. Now lease will also undergo a change. I cannot continue with the old value of 719 for lease. Lease will undergo a change now. Any doubts till now? Any doubts till now? Clear? The only thing is one calculation which I have stopped, which I have not told you to do is this 9.38% depreciation benefit computation. Next, evaluation of lease option. Evaluation of lease option. Evaluation of lease option. Do at 9.38%. Evaluation of lease option. Do at 9.38%. Earlier we did it at 8.04%. Now we'll change it as 9.38. Now you see lease looks to be better, and again we'll do an NPV. Like loan we did an NPV, lease also will. Now earlier we had a positive NPV, now we'll have a negative NPV. Earlier we had a positive NPV. How much was the positive NPV?
14,757.
Positive NPV at 12% was how much? 14,757. Now negative NPV at 14%. Negative NPV at 14% is minus 14,954. One positive, one negative. It will come closer to 13%. I think both the numbers are broadly same. The answer is indifferent interest rate is L1 12 plus NPV at L1 14757 divided by NPV at L1 minus NPV at L2 into L2 minus L1. 14757 divided by 14757 plus 14954. 69? Okay, I am getting 696827. It's okay.
Minus 717,679. What's the NPV?
So 711781 and 696,827 are the two numbers I have. You can have a slightly different numbers. This is at 9.38%. At 9.38, these are the two numbers I have. Yours can be slightly different. You will have a slightly different answer. That's okay. That doesn't really matter. Into 2, sorry, L2 minus L1. I get it as 12.99%. 12 plus 14,757 divided by 14,700. L1 plus NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1 into L2 minus L1. 12.99%. You can then finally write sensitivity is changed by base into 100. At 12%, loan is better. At 12.99%, lease will be better. Beyond 12.99. At 12%, loan is better. Beyond 12.99, lease will be better. Answer is change by base into 100. Change by base into 100. Change by base into 100. How much do you get? 8 point, okay, that is 0.99 by 12. So the project is more sensitive to the cost of the asset. Now just for a verification purpose, if I change it as 12.99, 12.99 into 67%, which is 8.70%. If I make it as 8.70%, 8.7033, if I make the discount rate as this is how the factors will look, and both will look same now. 709 128, 709 316, small differences because of rounding off. Otherwise both remain same at that level. Any doubts on this? Clear? So with that, leasing is over. In leasing, the critical part is going to be from an exam point of view, how do you fix an indifferent lease rental and doing a leasing versus loan analysis. Leasing versus loan analysis. We have seen good number of problems. Either you use a shortcut method which is this approach, cost minus present value of depreciation benefit minus present value of salvage value, or you end up doing a detailed approach, which is year, interest, installment or principal, depreciation, tax saving on interest plus depreciation, salvage value, NCF, PVF and DCF. With that, leasing is over. I'll end today's session. I'm left with factoring and money markets. Both put together should be 4 hours of effort, so we'll try to wind up in the next week.